Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
After listening to today's news, you'll know first, Japan's historic rate hike ends a 30-year era of cheap money, threatening the global yen carry trade. We'll analyse why this policy divergence matters now and how the end of cheap Japanese capital could destabilise US stocks and bonds. Second, Brussels' plan to use 210 billion euros in frozen Russian assets hits a wall, threatening the euro's reserve status. We'll examine how this standoff creates a legal minefield for Euroclear and may impact the stability of Europe's entire financial plumbing. Third, Bank of England warns of AI-driven job displacement and a potential stock market bubble mirroring the dot-com era. So we'll discuss why surging US tech valuations are nearing dot-com levels and what it means for a potential market-wide correction. For the first time in 30 years, Japan just raised its main interest rate to the highest level since 1995, sending a jolt through global finance. The Bank of Japan pushed its benchmark rate to 0.75%, but the real story is the political whiplash behind the decision. The country's new Prime Minister, Sanae Takaichi, is now championing the hike. The problem? Just last year, she publicly called the idea of raising rates stupid. So what forced this 180-degree turn? A cost of living crisis? With core inflation hitting 3%, well above the 2% target, Takaichi is prioritising the inflation fight to shore up political support. The hope behind this move is that raising interest rates will strengthen the yen, making imported goods cheaper and easing the pressure on households. But actually, the yen's weakness isn't just about interest rates. A huge part of the problem is what economists call Japan's terms of trade. This is simply the ratio of its export prices to its import prices. For the last 2 decades, this ratio has been falling, meaning Japan has to export more and more just to afford the same amount of imports, especially energy. This structural problem means that small rate hikes might not be enough to fix the weak yen, and inflation could remain stubbornly high. This, despite the fact that higher rates increase the cost of government borrowing, the very outcome she once warned against. And this isn't a small risk. Japan's government debt is astronomical, with a debt to GDP ratio around 237%. By comparison, the ratio in the United States is about 122%. This creates a huge dilemma. The Bank of Japan needs to raise rates to fight inflation, but every hike makes it drastically more expensive for the government to service its massive debt. This puts the central bank's independence and credibility to the test. However, this is where the situation takes a more complex turn. Some experts are already saying this historic move might not even work. One chief strategist noted the rate hike was already priced in by currency markets, meaning it may do little to strengthen the yen and ease the cost of imports. A stronger yen has major implications for regional competition, especially for China. If the yen does appreciate significantly, it makes Japanese exports like cars and machinery more expensive on the global market. This could create a structural opening for Chinese manufacturers. We're already seeing this trend. For example, in 2023, China's auto exports surged by over 60%, putting it on track to overtake Japan as the world's top auto exporter, largely driven by its strength in electric vehicles. A sustained strong yen could accelerate this shift in global supply chains. So what is the real endgame here? While Japan is tightening its belt, the world's other major central banks are headed in the opposite direction. Both the Bank of England and the US Federal Reserve have recently cut their interest rates, putting them at multi-year lows. Japan is now completely out of step with its global peers, embarking on a high-stakes economic experiment alone. This divergence, interestingly enough, threatens to unwind something called the yen carry trade, which could destabilize global finance. For decades, investors have borrowed yen at near zero interest rates and invested the money in high-yielding assets like US stocks and bonds. It was basically a giant global bet funded by cheap Japanese money. Now that Japanese rates are rising while US rates are falling, that gap is closing. Investors are being forced to sell those foreign assets to pay back their yen loans. Recent data from the Bank for International Settlements already shows a sharp halt in the growth of yen-denominated credit, suggesting this unwind is happening fast. This forces the sale of popular assets and could cause a sharp, disruptive appreciation of the yen, sending shockwaves through global stock markets. After all, For nearly 3 decades, Japan's ultra-low interest rates effectively provided a global liquidity subsidy, a river of cheap capital that flowed into assets all over the world, especially US. Treasuries. The normalization of Japan's monetary policy marks the end of that era. As Japanese investors bring their money home to invest in newly attractive domestic bonds, a key pillar of support for global asset prices is being removed. In the near term, we should watch for continued repatriation of funds by Japanese investors, which could point to permanently higher bond yields and, consequently, lower equity valuations worldwide. Speaking of high-stakes economic moves with global consequences, a financial showdown of a different kind is unfolding in Brussels over 210 billion euros in frozen Russian assets. Ukrainian President Volodymyr Zelensky is making an urgent plea for the funds, warning that without a deal, his country faces a big problem as its finances are set to run dry in a matter of months. And that urgency is no exaggeration. According to recent analysis from the International Monetary Fund, Ukraine's budget deficit is projected to hit a staggering 20% of its GDP. The proposed EU loan is designed to cover about half of this massive shortfall. Securing these funds is a critical lifeline that directly impacts Ukraine's ability to sustain its defence, which in turn affects global markets for things like grain and energy. The European Commission has a plan on the table, loan Kyiv about 90 billion euros from those frozen assets, but this deal is hitting a wall of opposition. The heart of the conflict lies in Belgium. The vast majority of the cash is held by the Brussels-based organisation Euroclear, and Belgian Prime Minister Bart de Wever is not convinced, stating, "I haven't yet seen any text that would persuade me to change Belgium's position. Belgium's hesitation goes far beyond simple politics." This move would set a major precedent in financial warfare. And here's where it gets interesting. It could threaten the euro's status as a global reserve currency. You see, central banks around the world, especially in countries like China, hold vast sums of euros as part of their foreign exchange reserves. If the EU establishes a precedent that these assets can be seized and repurposed, it could trigger a long-term reevaluation. Those countries might start diversifying their reserves away from the euro to protect themselves, which would reduce demand for the currency and ultimately increase borrowing costs for all EU member states. And he's not alone. This isn't just a political debate, it's a high-wire legal act. Russia has already filed a lawsuit against Euroclear to reclaim its money. The move also tests a core principle of international law called sovereign immunity, which generally protects a state's assets from being seized by foreign courts. Russia's lawsuits and threats to seize Western assets in retaliation are a stark reminder that the weaponization of finance is not a one-way street. If Russia's legal challenges are successful, or if they engage in tit-for-tat asset seizures, it could create billions in liabilities for European companies and financial institutions. The risks are so severe that Italy's Prime Minister warned a legally unsound plan would be handing Russia its first real victory since the beginning of this conflict. The opposition front is growing. Hungary has made it clear it will not allow any more EU money to help Ukraine. Slovakia has also voiced objections, and other nations like Malta, Bulgaria, and the Czech Republic are reportedly unconvinced by the controversial proposals. Believe it or not, the disagreement itself is becoming a major stress test of EU unity. A failure to reach a consensus on such a critical foreign policy issue signals political fragmentation. This could undermine the bloc's credibility on the world stage and even weaken investor confidence in joint EU debt. Even financial markets are on edge. Ratings agency Fitch has placed Euroclear on a negative watch, citing the legal risks to its balance sheet from the Commission's plan. To understand the gravity of this warning, you have to know that Euroclear isn't just any bank, it's a central securities depository. Think of it as the critical financial plumbing for Europe, responsible for the settlement of trillions of euros in securities transactions. Fitch's warning signals that there's a real risk of a confidence crisis. A credit downgrade or a successful Russian lawsuit against Euroclear could trigger contagion, spreading risk throughout the broader European banking system as trust in this core piece of infrastructure wavers. So a single political decision is now putting the stability of Europe's entire financial system under a microscope. This all puts EU leaders in an incredibly difficult position. European Commission Chief Ursula von der Leyen admits the urgency for Ukraine is acute, but with Belgium holding the keys to the vault and a growing number of member states refusing to turn them, the plan to fund Ukraine with Russia's own money is hanging by a thread. While European leaders grapple with that immediate financial risk, the Bank of England is looking at a more long-term structural threat. Its governor just issued a stark warning comparing the impact of artificial intelligence to the Industrial Revolution. He predicts AI won't cause mass unemployment, but at times will displace people from their jobs, and that the workforce needs to be prepared for this shift. The key here isn't just about losing a job. It's about the job itself disappearing and being replaced by something that requires entirely new skills. This is a structural change, not a temporary downturn. This isn't a distant future. The displacement may already be starting. Official figures show the number of unemployed 18 to 24-year-olds in the UK just surged by 85,000 in the 3-month period, the largest jump in over a year. Now get this, while youth unemployment is spiking, the overall unemployment rate has remained relatively stable. This mismatch is a classic signal of a structural shift where one specific group is being disproportionately affected. Research shows this isn't an isolated incident. Major accounting firms, for example, have already started cutting back on graduate hiring. KPMG reduced its graduate intake by nearly 30% and Deloitte by almost 20%. This disconnect risks creating a persistent experience trap for new graduates. If entry-level jobs are automated away, how can young people get the experience they need to build a career? This could damage long-term productivity and worsen inequality. And this isn't just a government forecast. The global chairman of accounting giant PwC put it bluntly, stating the firm is scaling back hiring plans. His words, "We want to hire, but I don't know if it's going to be the same level of people that we hire. It will be a different set of people." And this different set of people, he mentioned, they're the ones with skills in data analytics, AI prompting, and systems integration, rather than the traditional entry-level skills of data entry and basic analysis that are now being automated. The core conflict is emerging in real time. Entry-level professional jobs in sectors like law and accountancy are seen as the most impacted. Firms that once paid consultants for weeks of data analysis can now use AI to get the same results in minutes. A while back, we also flagged that the AI build-out is concentrating on a few supply chain choke points, especially advanced memory, and is scaling faster than the ecosystem can comfortably support. That concentration helps explain how quickly firms can automate routine analysis, but it also sets the stage for broader ripple effects if a bottleneck snaps. And the concern stretches beyond the job market and into the stock market. The Bank of England has also sounded the alarm over a potential AI bubble, raising fears of a crash similar to the dot-com bust. We previously analysed how this surge is clustered in a handful of choke point suppliers. The latest development is that such concentration could amplify any market correction into something more systemic. The Bank of England's Financial Policy Committee is pointing to specific warning signs. For example, a key valuation metric, the cyclically adjusted price-to-earnings ratio in the US, is nearing the levels seen at the peak of the dot-com bubble. This suggests markets are potentially overvalued. A sharp correction in tech stocks could trigger what's known as a negative wealth effect. When stock portfolios shrink, people feel poorer and spend less, which can slow down the entire economy and put pressure on central banks to change course. It also intersects with something we discussed a while back, heavy AI investment risk crowding out other sectors, creating AI haves and have-nots and deepening those spending shocks. The CEO of JP Morgan has stated he is far more worried than others about a serious market correction in the coming years. Governor Bailey confirms that policymakers must watch the valuation question very closely because while many big tech firms are generating cash, it doesn't guarantee they will all be winners, especially if we see supply gluts in legacy chips even as high-end components remain constrained. To dig into this valuation question, you have to understand a concept called the productivity paradox. This was first observed with computers in the 1980s. We saw them everywhere except in the productivity statistics. We may be seeing a similar paradox with AI today. Companies are investing billions, but broad economic productivity gains are still lagging. The UK's own budget office has actually revised its productivity growth forecast downwards. So the thing is, it suggests that stock market valuations are based on the promised times of future AI-driven productivity, not the current reality. This gap between hype and actual output is the classic fuel for a speculative bubble. For a market like China's, which is also heavily investing in AI, this serves as a cautionary tale. A focus on real-world application and measurable efficiency gains will be crucial to avoid a similar valuation trap. And as we noted earlier, surging demand for high bandwidth memory highlights the gap facing domestic chip makers, if high-end components remain out of reach, there's a risk of building capacity where glut is more likely than productivity gains. So what should we watch for next? Keep an eye on 3 things. First, graduate hiring announcements from major professional services and tech firms. Further cuts would confirm this displacement trend is accelerating. Second, watch quarterly productivity reports from major economies. If these numbers start to consistently tick up, it means AI is finally delivering on its economic promise, which could support current stock valuations. If they stay flat, the warnings of a bubble will only get louder. Third, monitor supply side and price signals across the AI stack earnings from the broader ecosystem, not just chip designers, but crucial memory suppliers, and the semiconductor producer price index. These will tell us whether bottlenecks are easing and whether AI investment is starting to crowd out other sectors. This content is for informational purposes only and not investment advice. Market information is subject to rapid changes.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.